Okay, good morning, good afternoon, good evening, depending on where you are in the world. I'm Nicolas Véron. It's my pleasure to introduce this session of the financial statement series at the Peterson Institute. And today we'll focus on Turkey, as it's now called, formerly known as Turkey, and its very idiosyncratic economics and finance under the current government. And for that, we will have today Turalay Kenç, who is a professor at several universities and former deputy governor of the Central Bank of Turkey. I will introduce him in a second. And Sinan Ülgen, who is a visiting scholar at Carnegie Europe, among many different qualifications. Professor Kenç got his PhD at University of York in the UK in 1993. He worked at different universities there in Cambridge, Birkbeck College in London, University of Durham, Imperial College London, and then at Bradford University School of Management, where he was professor of finance. And in April 2009, he joined the Central Bank of the Republic of Turkey, the TCMB, where he was initially a board member and in 2011 became deputy governor, a position he held until 2016. He then went back to Cambridge. He was also affiliated, he is affiliated actually with the Turkish university, the TOBB Economic and Technology University in Ankara, where he's a professor of finance, currently on leave and teaching in Malaysia, from where he joins us today from Kuala Lumpur at INSEIF, a local university, since September 2021. He remains a board member of the Cambridge Endowment for Research in Finance. When he was a central banker, I should mention he was also the chair of the Irving Fisher Committee on Statistics at the Bank for International Settlements, and has published widely on a number of financial issues and, of course, issues connected with the Turkish economy. Sinan Ülgen graduated from University of Virginia in 1987 in both computer science and economics, which is a perfect combination for this discussion, and also got a master's from the College of Europe in Bruges in 1990. Then he served in the Turkish diplomatic service in different positions, including in Brussels and Tripoli in the 1990s. He then left the civil service, created a significant think tank in Istanbul called EDAM, the Center for Economics and Foreign Policy Studies, together with Kemal Dervish, and also co-created a significant consultancy also in Istanbul called Istanbul Economics. He's been for several years a visiting scholar at Carnegie Europe, and joins us from, I think, Brussels, but I'm not sure.
Paris, actually.
Paris, actually, even a suburb of Brussels. Professor Kenç, over to you, and looking forward to our conversation today.
Well, thank you very much for the kind introduction, and thank you for this opportunity to speak at your prestigious institution. So I will talk about Turkey's unorthodox monetary policy. So I have these 4 plots to summarize what's going on in Turkey. It's the state of play in the Turkish economy. If you, the one top left says that currency depreciation was quite low to mid-2018. It is 280%. And then no emerging market economy close to Turkey, right? You would think that this level of depreciation would solve Turkey's balance of payment problem. Well, it helped, but it did not solve really. If you look at the bottom right plot, you will see that the current account deficit to GDP over the last 9 years, 3.3%. So what happened? So where the depreciation went? Well, it's inflation. So inflation basically substantially increased. CPI inflation is currently 73.5%, and PPI inflation is 132%. I will talk about this PPI inflation later on a lot. So as a result of that, Turkey's 5-year CDS jumped to 835, which is a significant number. Okay. So what was the reason that Turkey's balance of payment did not improve much? The reason basically PPI inflation. So since mid-2018, the PPI inflation is 336%, so massive inflation. So basically that wiped out all the gains from the nominal depreciation that Turkey generated through currency depreciation, right? So as you see on this graph, the PPI-based real effective exchange rate did not improve recently. Although unit labor cost, real effective exchange rate improved a lot. So that's one reason why the depreciation did not lead to any improvement, much improvement, in other words, on the balance of payment problem of Turkey. There are other reasons. The depreciated euro versus integrated real effective exchange of Turkey, which is more sophisticated way of measuring the real effective exchange rate, which is quite important for Turkey. And also inflation uncertainty basically impedes production and trade activities. So all these things are very negative for Turkey. So Turkey lost competitiveness due to low productivity, and then the first demographic dividend ended in 2017, and then import dependency is still too high. It's in the region of 60 to 80%, both at aggregate and firm level. The currency depreciation basically works through expenditure declining channel rather than expenditure shifting channel. Okay, and then all these developments basically led to an increase in external funding cost of Turkey. I mentioned the CDS spread jumped to 835 from 360 in September 2012. Similarly, Eurobond interest rate on Turkey's 5-year instruments increased 4.4% to over 10%. So Turkey faces significant external funding requirement. The short-term external debt to GDP ratio is almost 23%. And the current account deficit to GDP ratio probably is going to be in the region of 3 to 4%. And there's another channel which leads to external funding requirement is the net international investment position, which has been declining. So that's another source of demand for currencies. Okay, so for the sake of time, I will skip certain slides. I will concentrate on the most important ones. This one is important. Elevated debt service to GDP ratio. Turkey, one of the highest ratio. It was the highest a couple of years ago. Why? Because of the currency depreciation and higher funding cost. Okay, so what caused this problem? It's basically monetary stimulus. So at the backdrop of regulatory policies, at the backdrop of declining potential growth, weakened institutional quality, policy credibility, and strong headwinds basically led to problems that I described earlier on. So that led to basically flow balances and the stock balances problem. To a certain extent, Turkey had flow balances problem in the past, but the stock balances problem is something new for Turkey. Okay, that's basically the reason, because the unorthodox policies that Turkey implemented. Still, Turkey implements unorthodox policies, despite the fact that Turkey faces really significant headwinds in terms of high commodity prices, rising interest rates, and credit risk premiums, and a weakened external financial safety in the sense that Turkey has a really depleted FX reserves. And dollarization is an important phenomenon in Turkey. As you see, that Turkey achieved a great deal of success on this until mid-2010, but afterwards, due to unorthodox policies, the financial dollarization has been increasing in Turkey. So after de-dollarization, now Turkey is facing a re-dollarization episode. Okay, so what led basically dollarization in Turkey? Volatile growth rate. If you calculate the kind of risk-reward ratio, I calculate the Sharpe ratio, for example. Turkey has the lowest Sharpe ratio because of the high growth volatility, despite the fact that Turkey's mean growth rate is higher than peer emerging market economies. Okay. So I'm going to explain this very interesting relation between loan growth and FX depreciation. I identified 4 episodes of currency depreciation in the last couple of years. One right after 2018, 2020, early 2021, and the late 2021. As you see, those are bands which represent those episodes. As you see that all these currency depreciation episodes preceded by loan growth rates. So those are quarterly growth rates. So the blue lines. Same picture can be, same story can be read from the negative real policy rates. Whenever a policy rates in real terms negative, so that led to currency depreciation in Turkey. So what Turkey needs, first of all, the Turkey should anchor inflation expectation by hiking policy rates. As you see that policy rates of other emerging market economies have been on the rise. So they are close to Turkey's policy rates, despite the fact that the highest one is only 1/3 of Turkey's inflation rate. Okay, what do we need? We need basically structural reforms. And unfortunately, Turkey succeeded a lot in terms of first-generation structural reforms, rule-based policies, market economy principles, independent economic financial institutions, and institutional quality. So we have to redo these first-generation reforms, but also we need to do second-generation structural reforms. These are more to do with the productivity and microeconomic natures, but these reforms basically require broad-based consensus, plus it will cost. So I will stop here.
Thank you very much. And that was quite the worldwide tour of all the problems of Turkey. One question I have, just for clarification before giving the floor to Sinan, and you may, by the way, unshare your screen so that we can see each other. One question is about dollarization. When you talk about dollarization, and I will display my ignorance of the Turkish situation here, is it all US dollar, or is it a mix of dollar and euro and maybe other currencies?
Mostly US dollar, but euros too. I think 2/3 in euros and 1/3 in, 2/3 in US dollar and the remaining 1/3 in euros.
Thank you. And on that note, Sinan.
Well, what I'll try to do, first of all, Nicolas, many thanks for your kind invitation. It's always a pleasure and honor to share the floor with you and Professor Turalay Kenç. What I'll try to do is really be complementary in terms of my evaluation and assessment of the situation, and try to make sense of why did we end up here, because what Professor Kenç shared with us are indications regarding the vulnerability of the Turkish economy. So I think one needs to understand why is it that we got here, and what's the backdrop to this, framework of economic vulnerability. And here I would like to underline 3 main points. The first one is about the president himself, because a lot of what we see today in terms of economic policy making has to do with him. Over the years, what we have witnessed in Turkey is really a transition to a system which has been accentuated with the transition to this, presidential system in Turkey, which is a presidential system in name only, because it doesn't really have the types of checks and balances that one would associate with a presidential system. As a result of which, a lot of the decision making, including in economic policy, has been concentrated at the top. And, normally you would expect a system of governance for a country like Turkey that is a high middle income country that is, more diversified, where, the weight of the institutions, including the central bank, is important. But over the years, recently, what we have seen is an erosion in the influence of the institutions to the advantage of the presidency. And now, even monetary policy decisions are essentially, a byproduct of the presidential decision-making, more than what you would expect in a developed economy, which is, the central bank and the independence of the central bank. So a lot what we see today is really a consequence of the, this particular system of governance. So this would be my first point. My second point is that, even in this rather flawed system of governance, you might have expected a different outcome if more conventional economics had been the norm. Alas, it is not. The Turkish president believes that, in a context like this, when inflation is rising, interest rates have to be reduced. Over and over again, he has repeated the mantra that it is interest rates that drive inflation, and not vice versa, which many of us tend to believe, having had some training at least in the profession of economics. So as a result, this is, Turkey has become a textbook case about whether this, Erdoganomics or the Erdogan doctrine of monetary policy is wrong or is right or wrong. Because what the country has been doing, and surprisingly so, is to reduce interest rates at a time when inflation is rising and rising. So today we end up in a situation which is unique in the world, of being a country with a negative real interest rate of almost 55%, minus 55%. That's, the negative, real interest rates. Only because, in this system of governance, the Turkish president is still, bound to his mantra that in order to fight inflation, you have to reduce interest rates. The third point is that this is happening at a time with a specific political backdrop, which is that Turkey is heading towards a critical set of twin elections. The elections are, the presidential elections and parliamentary elections are set for June 2023. So there is an incentive on the side of policymakers to essentially boost economic growth. And in order to boost economic growth, we basically see this, lax monetary policy, lowering interest rates makes sense from that perspective, according to government policymakers, but also accompanied with, other measures like, cheap credit allocation, especially driven by state banks. So Turkish consumers have access to mortgage rates that are about 17% per year at a time when again CPI is about 75%. Similarly for consumer credit, which is slightly higher, about 25% nominal, at a time again when CPI is 75%. So this creates, an economy where, it's a consumption-driven economy, where also because of rising inflation, you have the front-loaded of consumption, which is driving domestic demand. But it also generates, on the one hand, increased fiscal outlays by the government, and probably about 5 to 6%, budget deficit by the end of the year, which is surprising for Turkey, because one of the points of resilience of the Turkish economy had actually been strong fiscal balances. But that's also under serious threat. And also, rising current account deficit because of, this liquidity, cheap liquidity financed domestic consumption, which is something internal, obviously, but also external conditions that has affected other economies, like rising food prices and rising energy prices. So this is really the backdrop to what we see nowadays, this fetishism about growth, which is perhaps partially, rationalized by the fact that the country is heading towards elections. However, this, the fact that there is no policy reversal on the horizon because of the, threshold of elections, does increase the risks of some unwanted sudden stop or shock, particularly one that would manifest itself as a balance of payments crisis on account of the depletion of the reserves. So on that sour note, unfortunately, I want to end my initial set of remarks here.
But that's exactly the point of this session, in a way, and that's a question which has already been asked in the Q&A by Ted Truman. How is it possible, and maybe first to you, Professor Kenç, how is it possible that there hasn't been an external crisis yet? And what explains, in your view, that despite those unorthodox policies, which Sinan explained very well, which have lasted for a number of years now, how is it that Turkey has avoided a sudden stop or some form of external crisis for so long? What's the secret of the Turkish central bank or the Turkish authorities?
Well, the banking sector is in good shape. They are the simply important institutions, and they are the source of financial crisis most of the time. Right now, they are in good shape. How long it's going to carry on remains to be seen. So that's very important. And then they do business now with the central bank. So they have zillions of foreign currency denominated deposits, but they cannot really provide loans out of that. So they provide loans to the central bank through swap agreements. So currently that's the situation. But bear in mind that we have been having financial kind of currency turmoils. The last one I already talked about. So it's to a certain degree, the financial turmoils are there, but for the financial crisis, it has to do with the banking sector.
And is there there's a question from Joel Henderson. Is there any retail lending taking place at all in local currency? Because, when you have negative 55% interest, what's the incentive to lend at all? Or how can you give us a little bit more of a sense of the balance sheet structure of local banks and how they can cope with this environment?
Is the question to me?
Yeah.
Okay. Yeah. For them, it's not easy to provide foreign currency loans. Instead, they provide Turkish lira loans, and then the foreign currency loans basically through with the central banks. So they provide foreign currencies, and the central banks provides them the different instruments. Right. That is a swap agreement basically. And when it comes to banks, for them, really, it doesn't matter at what rate you are borrowing and at what rate you are providing loans. As long as the difference is healthy, the margin is healthy, they are fine. Right now, the margin is healthy for the banking system, but it is not healthy for the economy. So it's a kind of systemic risk issue for Turkey. So you borrow money from the central bank at the interest rate of 14%, and you provide loans 35, 40, whatever is the interest rate, right? They charge. It's clearly much less than the real interest, positive interest rate you would think of at the inflation rate of 73.5%. So that, for banks, what is important is the margin, right? They have the margin, they are profitable, but at the expense of the healthiness of the economy.
And just to follow up on what Sinan was hinting at, do you think it's possible for this situation of suspended disbelief to last until the election, or is it inevitable that there will be a more disruptive moment of instability between now and the election in a year's time, Professor Kenç?
Well, obviously it depends on the market reaction, whether markets will continue providing fundings to Turkish banks, to Turkish corporates and the Turkish government or not. So currently, the borrowing cost increase for Turkey, but there is no event of sudden stop yet.
Sinan, obviously there's a war just north of Turkey going on. The geographical position of Turkey and also its history puts it very close to the front lines of the war in Ukraine. How does that change the equation? And can you give us a sense of how, does that create opportunities because Turkey is in NATO and can receive support? Can you give us a sense of the different strands in which the war in Ukraine is affecting our topic today?
Well, it certainly has been a most unwanted development for Turkey, like the rest of the world. But Turkey, because it's been vulnerable to some of the consequences of this war at a time when, as discussed this morning, today, the economy itself is already very vulnerable. First of all, the global impact of the war has been a predicament. With rising food prices, rising energy prices, which come to fuel already very strong inflationary tendencies. So that's, the first part. Secondly, it also has a negative impact on the current account deficit at a time when there are questions about the sustainability of Turkey's balance of payments. Thirdly, it also raises Turkey's financial risk. A lot of that is, policy induced, but some of them are due to external factors. As discussed previously, Turkey's CDS is now up to about more than 800 basis points. Then there are questions also about the fact that both Russia and Ukraine were among the top 3 countries in terms of sending tourists to Turkey, and the fact of having tourism revenues is very important, and they might be a shortfall in those revenues. Although surprisingly, the first few months' data point to the contrary, that Turkey is actually having quite a good tourism season despite the war in Ukraine. And that's definitely, good news from the perspective of Turkish policymakers. But ultimately, of course, we really don't know where the war will end. So we really don't know where some of these, negative externalities will end. And especially if we end up in a scenario of protracted war, which is unfortunately more likely, it seems, on the ground. then these negative impacts, both on on food but also on energy prices, is likely to be the case for the longer run, and there won't be any short or medium term sort of breathing area for countries like Turkey that will be exposed to the negative externalities of this war. Turkish policymakers have crafted what I think to be, a rather skillful diplomatic engagement with Russia and Ukraine to minimize the risks to Turkey. But nonetheless, these economic risks are there, and they have affected Turkey's economic performance and indicators.
Excellent. Well, excellent. No, not for Turkey, but I encourage we have a lot of very qualified participants in the audience, so I encourage them to use the Q&A tool to raise questions, or even if you want, raise your hand virtually. But certainly use the Q&A. I have more questions of my own, of course, and one of them is about trade and how the last few years have affected Turkish trade in terms of its general orientation. Has there been more integration with Europe, less? Do we see more integration with the Middle East? Maybe Sinan first on this as well.
Well, I mean, these economic, duress has certainly impacted foreign policy. So much so that some of the, foreign policy activism that we had witnessed over the past decade has ended to be replaced by a different tonality in Turkish foreign policy. So for the past year and a half, Turkey has been trying to mend the relationship with some of the regional countries, in particular with the Gulf, in order to convince those countries to start investing in the Turkish economy. We have seen this at an accelerated pace with the United Arab Emirates. There are expectations that this would also happen with Saudi Arabia, and actually today the Prince MBS is going to be in Turkey, actually, meeting with President Erdogan, and there seems to be, to my surprise, a lot of international interest in this meeting. So I've been getting calls from many different major outlets to try to understand this situation. But on a less personal note, obviously, this normalization of Turkish foreign policy has to do with the dire economic situations, and not just in the region, but also we've seen, some movement as well with regard to the US and Europe, again, with much less, aggressive bellicose rhetoric. However, there has been, in reality, politically, very little progress on that front, both with Europe and the US, for two reasons. One is that, as now discussions in Turkey, wherever you go, whatever table you sit at, the discussion necessarily moves to elections. It's really been the talk of the moment, even though we are a year away from elections, and that is because it's such a critical set of elections. And I see to some extent the same type of phenomenon abroad, where many capitals now have adopted the wait-and-see approach. And therefore, there has been very little progress on the bilateral relationship between, at least the political relationship between Turkey and Europe, but also Turkey and the US, because of that wait and see. Mm-hmm. But secondly, also domestically, Turkey has lost the momentum for reforms, and that also weighs on the relationship.
Professor Kenç, on these issues of trade, security, and politics, any reactions?
Okay, well, Turkey benefited from the increases in trade volume, which is a positive news, and Turkey also benefited from the COVID and the follow-up supply side issues, so more integration with European countries. So that's a big plus for Turkey. And when it comes to, mending political differences with the Gulf countries, with other neighboring countries, as Sinan Ülgen mentioned. So that's a big positive for Turkey too. Turkey, those region, the Gulf region and the North Africa was one of the booming region for Turkey for exports. So that's a big good news for Turkey. But the exports, high import dependency, unfortunately, needs to be tackled. Without that, we will have trade deficit and the resulting current account deficit. But in terms of the volume, yeah, it's all positive.
And indeed, we have a question from Sisi Papadianidou on this. So there has been diversion of imports of the European that were coming from China and now come from Turkey. Is that the story that we should take away, or?
Well, to certain extent, you would say that, but unfortunately, producer price inflation is not happening in Turkey, and I showed that since mid 2018, substantial, almost drastic inflation on that front. That basically wipes out competitiveness gains you make from currency depreciation. So in that regard, Turkey is still some way to go to be really a rival to exports from China and other Asian countries.
Staying on the trade front, we have a question on a rule that apparently came into force in January this year, which forces exporters to convert 25% of their export revenue into liras. Can you comment on the impact of that, both at the macro and the micro level? Maybe both of you or whoever wants to comment on this.
Well, yes, it is a significant portion that exporters should hand in their revenues. Mind you that they take Turkish loans from the central bank and they return those loans in foreign currencies. So there is that sort of relationship going on between the central bank and the exporters. So this is an extra dimension, and a dimension with the ones that the central bank didn't have such relationship. So it's of course it's not market friendly policy, but at the same time, given Turkey's circumstances, Turkey needs external funding. So that's a source of funding for the central bank and for the economy.
Sinan, on that?
I'll be a little less diplomatic. What I'll say is that, when the government refuses to do the right thing in order to address the core of the problem, which is about, you have to have, a real positive interest rate, then, they try to find novel ways to try to appease the problems that are generated not by the core of the problem, but the symptoms of it. And this is exactly that. This is not a pro-market or a market-friendly measure. It smells like capital controls or light version of capital controls. And there's absolutely no need for that if the government does the right thing in order to fight inflation. So that's how I view it. Ultimately, the micro impact is perhaps negligible in the sense that companies are forced to sell. Now it's up to 40% actually of their FX revenues, but then they can buy it back. So what happens from the side of the corporates is basically they end up with the cost of that exchange 2 or 3%, whatever the margin is. That's the micro impact on companies. But even that, you wonder. I mean, why should there be a need for this type of policy?
very interesting. My colleague, sorry, go ahead.
There are more micromanagement policies on Turkish corporates. This one is you could legislate, but there are more micromanagement could be regarded worse than just handing export revenues to central bank.
Actually, we have a question about that, and we non-interest rate related tools, lira deposit incentives, caps on foreign exchange derivatives, tax on foreign exchange purchases, reserve requirements. Can you expand a little bit, because that's connected on the impact of all this on the current financial situation?
Well, yes. I mean, it's not new for Turkey. In the 90s, we had similar problems, and then we followed certain set of policies, and now we are copying the policies that we followed during those times. For example, exchange rate indexed deposits. In 1994, we had this instruments introduced by the government, and now we have the new one. And it didn't work that time because of the prospective budget deficits, and the realized deficit killed the policy. And this time it's going to happen. It's going to be the same. Already the deficit is going to be sizable on the government budget because of the depreciated lira in the last couple of months. So these policies are not going to work in the long run. It delivers a little bit result on the very short run. So when we had the really financial turmoil on the 21st of December, that was the policy that they come up, which is nothing new.
Sinan, on that? You're muted.
Yes, I think I have little to add to what Professor Kenç has stated, really. But all of this is really an indication of what I've tried to outline in my previous remarks, which is that when you don't do the right thing, in terms of fixing macro policy, then the government is trying to address the symptoms of a problem that has been generated by those four macro policies. And ultimately, this is not a way that will produce the expected results for the future of the economy. There needs to be a reckoning that there is a core problem here, and there needs to be a response to that core problem. However, looking at it from a political economy standpoint, it is also clear that as time goes by and as the country approaches this, fatidic electoral threshold, it's become increasingly more difficult for the government to give the right response, because the right response will need to be to raise interest rates and to have austerity measures. And that, so basically there's a race against time when you look at Turkey today.
Exactly. My colleague at the Peterson Institute, Adnan Mazarey, had asked for the floor. I think he has lowered his hand, but Adnan, if you want to interject, please. And also I want to thank you for the help you gave me in preparing this session. Adnan.
My pleasure. Very interesting presentation, gentlemen. My only question is this: short of a full-fledged economic blowout crisis, will this government consider going to the IMF and others in the international financial community to borrow? Thank you.
Professor Kenç.
Well, I think they said a lot about, against the IMF. Well, given that they didn't, keep their words, today the president going to meet the president of Saudi Arabia. It's possible.
I think that, first of all, let's define the crisis. The crisis that Turkey is facing is not a fiscal crisis. the crisis that Turkey is facing is a balance of payment crisis. And therefore, if indeed we end up with that sort of scenario, the government will have to think twice about this very categorical refusal not to go to the IMF. Of course, it would be seen as a very unenviable position for Erdogan, who has, over the years many times repeated the fact that, Turkey has left behind the IMF years. IMF has, acquired a degree of toxicity in the domestic political language. So it will be very, very difficult for him to go to the IMF. However, this question also is relevant in the case of a, political change in Turkey. Because if there is a new government that inherits this rather, very, very difficult economic environment with vastly depleted reserves, maybe they would want to go to the IMF because ultimately Turkey will need that fresh, pool of foreign exchange in order to essentially evade or a balance of payment crisis, even with a new government. Because even with a new government, even if they start to do the right things, with IMF support, the social cost, interestingly, and the duration of that economic hardship is likely to be less.
Thank you.
So, how high is the risk that all these dollar accounts and euro accounts that you showed us, Professor Kenç, are going to, get out of the country? We have questions from both Ted Truman and another participant on this. Is there, if all these foreign exchange deposits go to foreign banks, that would obviously put pressure on the reserves, and the reserves are already pretty low. So can you map out this kind of scenario?
Well, currently they are there. Maybe a very limited amount of that could have been liquidated, but other than that, they have been in Turkish banks for many years. Some of them converted to FX indexed deposits, but large majority of them still in foreign currencies, in US dollar and in euros. So they are, it's just a kind of fictive accounts. You just go there and you say you have Turkish liras and you want to convert them into US dollar. That's the financial account. So you have no hard currency backed up the account you have. But so far, given that the government was prepared to provide currency-linked deposits, so that was received really positively by savers. But ultimately, you should say that they are happy to keep their foreign currency-denominated deposits where they are.
We have a question from Bill Klein on who is lending to the government. The Bank for International Settlements says that foreign currency debt is 14% of GDP, sovereign debt, I guess. But total government net debt is 35% of GDP. So Bill is asking, is it basically the central bank that is lending to the government, or via the banks? Professor Kenç.
That Turkey's government debt to GDP ratio is relatively low. So you're talking about 40% of Turkey's GDP. So it used to be 1/3 of that foreign currency. Now that increased due to depreciation. So you're talking about that sort of range, really. So the government has other ways of raising funding through private partnership, through other means rather than directly investing, directly spending money. So that's another reason Turkey situation is different than what we had in the past, is purely to do with the private sector rather than the banking sector and the government sector. But we know that these things can be very quick. Problem can be transferred from one sector to another sector within days. You don't need to wait for months or for years. So ultimately there is a problem. And there is problems of the private sector. So that will ultimately transfer it to the fiscal balances.
So I have a question on your own experience, Professor Kenç. I mean, you worked for a number of years at the central bank. You left it 5-6 years ago. How should we look at the institutions? We also have a question from Sesi Papadianidou on how Erdogan is advised on economics policy. Is it the Minister of Finance who makes the proposal, prepares relevant documentation and arguments? I mean, you mentioned, I think, I mean, Sinan certainly mentioned institutional parameters, and they were kind of underlying part of your presentation. Is there, to put it bluntly, how professional is economic policy management and especially monetary policy management, crisis management going forward, if that's needed? How would you rate the capabilities of the Turkish authorities in that space at this point?
Well, my understanding is that bureaucrats are there to save Turkey rather than to implement policies. So policies, as Sinan Ülgen elegantly explained, basically set up by the president. So that's his policies. When it comes to that policy, his prescription is very simple: zero interest rate, zero inflation, right? So the rest is basically left to the bureaucrats. If there's any problem, they have to sort it out. So they implement micromanagement policies, including policies targeting Turkish lira short positions, sort of things. So these are basically implemented at bureaucrats, but the ground policy basically prescribed by the president.
Sinan, you told us that, but how do you look at the central bank? Is it still a professional organization? Has its capacity been much eroded or only at the margin in terms of skill sets and competences?
Like many other institutions under this presidential system, the central bank as well, I think, has been harmed by this, this transition, which has centralized power at the top. And the central bank is is an institution that is part of the system of governance. So necessarily, it's also been affected negatively. That doesn't mean that there's no technical expertise left. On the contrary, there's still very competent people within the central bank, in other parts of the public administration as well. But overall, unfortunately, I have to emphasize that there has been an erosion, both in the independence, certainly in the independence, but also in the quality of the public administration since this transition has happened, and the central bank is not an exception.
One of you mentioned the state banks at the beginning. How should we look at them? Are they do they have anything like risk controls, or are they out of risk controls, Sinan and Professor Kenç?
Well, I mean, the central banks have a role to play.
State
banks have a role to play. For instance, there was a question of whether, who finances the Turkish government. What we've seen is actually over the past 2 years in a rather accelerated pace, a change in the composition of the debt The foreign participation in that debt, foreign institutions have come down. So a lot of that debt now, whether it's denominated in TL or in USD as Eurobonds, basically in fixed income market, we see a much higher share of the Turkish institutions, Turkish financials, and particularly the state banks. So first of all, there's that function. Secondly, the state banks also are being used to implement this lax monetary policy. They are the vehicle for the cheap credit policy. They're pushing ahead with these loans that are at, minus 40% real interest rates. And there's a very clear bifurcation, divergence between state banks and private banks. When you look at how of their loan portfolio and how aggressive they are. The private banks are much more conservative in terms of their loans, particularly mortgages, whereas state banks do most of the lending at rates well below the inflation.
Yeah, well, it is handy to have state-owned banks in difficult times. They act as government agents, and it's easy to implement policies for governments when you have them on your board, and it's going to be possible to implement what is called counter-cyclical policies through those state-owned banks. Yes, these are going to be helpful for the short term, but in the medium to long term, it's going to act against market discipline in Turkey.
We're getting close to the end of the hour. I would like to end with two questions which are directly about the politics of the current moment. One from Teresa Terminacian, who is asking how politically costly is the high inflation in Turkey, how it weighs on the political atmospherics. And the other one from Ted Truman, which is simply, is it going to be a fair election? And what are the prospects for a new government? What's the likelihood that the Erdogan system could yield in an election next year? Who wants to start with those two?
Well, I can answer the first one. I'm not sure about the last one. I'm not qualified to say, and then, it's not easy to answer the second one in general. You lose your professional view on that when it comes to new government and election. But I want to tell you about the first one. Yes, it is politically is going to be very costly. Well, right now, 75% of electors think that the most important problem is the economy in Turkey. This has been quite new. And since mid-2018, more than 80% of electors think that the economy is the most important issue. This wasn't the case before mid-2018, but since then, on a stable path, electors think that the economy is the most important issue. Clearly, what is the most important issue is the cost of living and the inflation.
Sinan?
Yes, I'll second that. And I'll say that there is now indeed a real prospect of political change next year. And it's basically because of the economic hardship, because of high inflation, because of people's eroded purchasing power and standard of living. And the mystery, therefore, for a politician that has been very smart over the past 2 decades, having dominated the Turkish landscape, is why does he continue with this flawed approach to the economy, seeing well that this is very much being detrimental to his chances of re-election? That's the $100 million question. And the way to answer that is twofold. One is that you can speculate that he doesn't actually see the reality on the ground, because otherwise he would change his policies. He's been encircled by a few advisors who conceal the realities on the ground. Or two, he actually believes that this economic program will deliver. He actually believes when he says that, you know, inflation will come down if he keeps the interest rate down. But no matter what he believes, you know, the polls indicate that his party is at the lowest level of support ever. And it's now more likely that the opposition will win the elections rather than Erdogan and the ruling party. Will the elections be fair? No, they won't be fair. But Turkey has a tradition of multi-party elections since 1946. That is very well embedded in Turkish people's DNA. So there's no other really, you know, sort of realistic scenario than Turkey going to elections and having a peaceful change of power.
Well, I don't know if this is an uplifting note on which to end the session, but thank you so much, Sinan Ülgen, Turalay Kenç, for a very enlightening discussion of countries that's actually very important. And I learned a lot. I hope our audience will as well, and I'm very grateful. Next session will be on July the 6th. We will discuss global financial infrastructure with the first speaker being Mark Bale, the CEO of CLS Bank, which is a critical infrastructure, even so it's not a household name. So we're going to move to international governance concerns, in which Turkey is also a participant as a member of the G20. The G20 still exists. Thanks so much, Turalay Kenç, Sinan Ülgen, and have a great rest of your day. Bye-bye.
Thank you. Bye-bye.